We've really seen interest rates come down pretty sharply over the last couple of days. A lot of people are starting to get worried that we're going to see a major economic slowdown coming this year. We've even seen expectations for Fed rate cuts getting priced back in. But the big thing here is that the dollar index has actually strengthened now 3 days in a row. Inflation swaps actually not coming down with Treasury rates. And so it really makes you wonder whether or not the nervousness we're seeing in the market actually really has to do with a growth scare. And as we touched on in a video earlier in the week, we haven't even really seen credit spreads really begin to widen by very much. But this week's going to play a really critical role in all of that because we're going to be getting a lot of important data. Monday, we're going to get ISM manufacturing looking for a 50.5. ADP private sector payrolls expected to rise by 143,000. Factory orders, we're looking for a 1.6% increase. ISM services, we're looking for a little bit of a rebound, 52.9. Obviously, jobless claims are a big number that everyone pays attention to. But the biggest number will obviously come on Friday with the payroll report. We're looking for 153,000 jobs to have been created. We're looking for a 4% unemployment rate. We're looking for average hourly earnings of 0.3%. That's expected to come down from the 0.5 last month, but last month's reading was really exceptionally strong. Year over year, we're looking for 4.1% in line with last month's. An average work week's expected to actually increase to 34.2 from 34.1. So, I mean, when you look at these numbers on the surface, it certainly doesn't look like there was a major slowdown in the month of February. Now, obviously, markets are forward-looking, but it's also really important to take the data on hand and really kind of think about what all of it means. And the one thing that's very clear is that inflation expectations have risen dramatically. In fact, if we go back to the day that we really started to see Treasury rates come down in a material way, which was February 19th. If you remember, this was the day that we got the University of Michigan numbers that showed a very big rise in inflation expectations, showed consumer confidence down. It was also the day we got the flash S&P Global PMI data points, which showed a slowdown in the services sector. But what's very clear is that we've seen a meaningful increase in inflation expectations. And while it's possible we could be seeing rates coming down as the market begins to price in potentially slower growth in the future due to higher prices, at the same time, usually we think about growth and inflation, they tend to go hand in hand. And what's very clear is that when we look at some of the Fed surveys, we've seen a really meaningful uptick in the prices paid components in manufacturing. Right now, we're looking at the Philly Fed, the Empire State, Kansas City Fed, Dallas Fed, and the ISM manufacturing prices paid indexes. And what's very clear is that when we look at the data points for the month of February, they all rose materially. And what this kind of implies is that we're likely to see an uptick in the ISM manufacturing prices paid index. In fact, if you notice, all of these readings actually went above where they were in the spring of 2024. And that would mean that maybe the ISM manufacturing report sees a very big move and potentially back above 60 based off of some of these preliminary data points. The other thing that's obviously very interesting is that we're looking for a reading of 50.2. Now, that's expected to be down on the manufacturing report, but last month was the first time we've seen the index actually rise above 50 since really 2022, October of 22, when we came down below it. And that's really an interesting point because while everyone is worried about a growth scare, they're not seeing the manufacturing sector contracting in February. We're actually seeing the manufacturing expected to stay in expansion for only the second month in a row. The other interesting thing is that we've seen inflation swaps rise meaningfully over the last couple of weeks. Now, this is despite the 10-year rate going from about 480 on January 14th to its current 420. And what's more interesting is during that same time, we've seen the 5-year swap reach 2.6% and is still now at 2.65%. We've seen the 2-year swap go from 276 and remain at 273. And we've seen 1-year inflation swaps go from 275 all the way up to 291. So while we're seeing interest rates coming down, we're actually seeing inflation swaps rising in some regards, or at the very minimum, staying flat. And really more importantly, inflation expectations have risen quite a bit. And in fact, they're above most of their previous highs in 2023 and 2024. And it appears they've actually broken out to some degree. And one would think that if inflation expectations were rising as much as they did, you wouldn't necessarily be seeing a major growth slowdown. Now, obviously, we could be entering a stagflationary period, but when we look at some employment trends, we're also not really seeing very much in the sign of, meaningful rises in the unemployment rate, at least based off of some of these data points. When we look at continuing claims and initial jobless claims have been in this range of, call it 200,000 to 260,000 now going back to 2023. And we've seen continuing claims really still around this 1.86 million to 1.9 million range now, also going back to 2023. It's certainly not really suggesting that we're seeing a meaningful rise in the number of unemployed workers. It makes you kind of question a little bit why the market is pricing in, or why the market is acting as if we're going to see a major growth slowdown, or why we're hearing about all these concerns. And it could very well be that the market is looking forward and saying that the Trump administration is going to cut lots of spending. Maybe it's because they're going to start laying off lots of federal workers. But at the end of the day, I've read the estimates are about 200,000 people or so that could lose their jobs. It really doesn't change the picture very much. In November, we had 7.1 million unemployed workers. And then by the time we got to January, that number had slipped 6.85 million. And so if we were to see 200 to 300,000 federal workers eventually hit the unemployment line, which was obviously something nobody wants to see, but even if we were to see that, it looks like we would just be returning to some of our previous levels, such as in November or maybe in July. And what's interesting is that in the month of January, we saw a meaningful uptick in the number of civilian labor force workers in the household survey, going from 168.5 million to 170.7 million. And that's one of the reasons why we saw the unemployment rate fall so dramatically. So even if we were to see 300,000 or 400,000 new workers hit the unemployment line, while it could lead to a little bit of slower growth, it's not likely to impact the unemployment rate materially enough to change the Fed's outlook on the overall economy, on its mandate of full employment by very much, especially in a labor force of 170 million people. It makes it really sort of tough. And it makes you, again, go back and look at what's happening in the marketplace and really think about why it is we're seeing interest rates come down as severely as they have. And I touched on this earlier this week in a video I had done, but we haven't even really seen credit spreads really rise in a material way. I mean, yes, we've seen the high yield index rise from around 260 and go to around 281, but this isn't like a significant increase. I mean, certainly when you look at where we are, even at current levels, we're below where we were at some of the lowest levels in 2021. And, you really have to start going back years to find lower levels on this index. In fact, you have to go back to 2007. Now, it's not to say, obviously, that credit spreads can't widen quickly, because obviously when you look at this chart, you see that credit spreads rose materially going into the fall of 2008. And in fact, they rose materially even throughout most of the late 1990s, even though the stock market was doing extremely well. But historically speaking, the majority of the time when credit spreads are rising, stock prices tend not to do very well. And that's because there's this elevated risk in the economy. One exception, obviously, was during this period of time between 1998 and 2000. But again, right now, we're not really seeing credit spreads even really signaling that there's some form of worry out there. I mean, now again, of course, if credit spreads continue to rise and we really start seeing them get into some of these higher levels, that's going to start telling us that the market really is getting worried about the economy. But what this is kind of implying to me is that the market is thinking about maybe a slowdown, but it's not really convinced that there is. And I think that this week's data is going to play a pivotal role in that, obviously. And so it really makes you wonder why, we've seen treasury rates fall the way they have. I think a lot of this, again, has to do with the fact that we have a lot of people who were short treasuries. And because you start seeing yields coming down and people are buying bonds, that causes people who are short to have to begin to cover their shorts. And that obviously creates the flows that are needed to push rates lower. We also came into end of month, so there could have been some reallocation and rebalancing taking place in portfolios as well. That could have played a factor. The other factor, and again, while this may seem fairly obvious to some, I wanted to point out as well that it seems like really over a period of time, we've really just seen the 10-year Treasury rate really trading with oil prices, and that makes sense to some degree since oil is a barometer on the health of the economy, since oil is also an inflation gauge. It's not really surprising to see that, oil prices have come back to the lower end of the range at around $70 a barrel, and you've seen Treasury rates also slip back to around 4.25%. My guess would be is that if we started to see oil prices really meaningfully start to go up again, then you would probably begin to see rates move up regardless of what the economic data is. And so that's what I'm sort of thinking about here. I don't really know that there's enough information yet to sit here and say, oh, the economy is falling apart. I mean, when we look at where these estimates are, it certainly doesn't look like that's the case. And I know some people have even made a big deal about this $153 billion negative trade imbalance that came out on Friday. And I wanted to point out, I thought this was interesting. What it looks to me is as if everyone was trying to import goods ahead of what could become, policy that results in tariffs rising. Because certainly we went from, being $259 billion in imports last year. We increased by 25% to $325 billion worth of imports versus 172 exports. And this very well could be just a major increase ahead of what is expected to potentially be, higher tariffs on imports. And certainly when you look at some of the categories, industrial supplies, capital goods, those were really consumer goods. That's really where the big increases were. And again, that could be tariff related, people front running it. So, a lot of signals out there that are kind of confusing. And obviously this number played a really big role in that Atlanta Fed GDP downgrade. When we go to the Atlanta Fed, what went from the first quarter is now expected to be a negative 1.5% on February 28th, down from 2.3%. But if you actually go and you look at the subcomponent charts, what you'll see here is a really big you'll see that really big decline. And when you look at what this decline is, this has to do with the net exports. And so this is what's leading to that really big decline in the GDP numbers. And so, again, if there's some front running of tariffs, this could be playing into and making the first quarter numbers look a lot worse than what they really may otherwise be. So anyway, I hope you found this video helpful. Please remember to share it with your friends, subscribe to this channel. Let's continue to grow this channel out in 2025. We had a really great start in 2024. I reached over 25,000 subscribers. So I thank you for that. Let's try to make it 50,000 subscribers this year, but I need you to help me do that by subscribing and following this channel. Have a great weekend, and we'll see you all during the week. Bye.